Okay, today is July 11, 2022. Just doing some simulated trading on a strategy that I've been trying to work out, and it seems to be coming together really nice. The idea behind this strategy is to trade in a way where we eliminate Vega using multiple time frames and different combinations. So, and that really does make a difference. Vega, typically, if you go with a single strategy like a butterfly, a iron condor, a calendar spread singularly, it won't. Vega is going to be the dominant Greek. It's going to be dominant over everything else. So if there's a big move in the market, you're going to find that your position is dramatically affected by Vega. I've seen that many times. So then, this is kind of an answer to that. Okay. So you can see here we have two, just on our monitor page, which is just a little different in of itself. You have two expiration periods. And I am writing that out in the monitor tab. So like this one is September 16 expiration, 66 days to expiration, and we started this today on 7/11. So let's take a look at this one. So just take a look at the statement first, the trade page. And I'm going to pull up that, and you're going to see that, the first thing that kind of pulls up is that on the put side, you have a vertical spread that's at 30 delta. Are we going to roll on down? And we have a short position here at 38.55, where that is a calendar spread embedded in the iron condor, and I'm going to get into that, why that's important. Okay, you see a long position, long short, long vertical here, and further out we have another call spread another short call vertical at 30 delta. Okay, now what this looks like is we'll go into our analyze and go to groups. We're going to this one, 66 days to expiration. So this is what we look like right now. We just started this today. Very neutral. The delta here is nothing. Gamma is nothing, and theta is coming in at $45 a day. Vega to theta ratio is half of that. Okay, and if you were to put on just to kind of illustrate the power of this thing, like if you were just to put on a iron condor, right? Okay, now here's everything taken out. Like the calendar spread is taken out, the vertical is taken out, and you're just left with this iron condor. Okay, now look at the Greeks here. The Vega is almost five-fold theta. Okay, almost five-fold. That means that if Vega were to go up, if the market would make a sudden move and volatility goes up, this is going to dramatically impact the P&L. And then you may not even, to such a degree that you may not even be able to catch up to it, your loss just from the move in volatility. So when you start off with a combination, like you add in a calendar, let's add in the calendar. See, we have a short put here and a long put in the back month. Okay. Now when we did that, we dropped that Vega down, and now theta is the dominant Greek. Okay, earlier today the market kind of started going up a little bit, and I started to see that the P&L was starting to get away from us, so I put on a call spread. Okay, and that brought those deltas back into line again. So using just a few things, a few things embedded in the strategy, you can really start to control these Greeks a little bit better, and really smoother trading. I took off some profits today from this period, and took off a whole bunch of stuff, but it was like a $1,600 profit trading with a fictitious 20,000. Not bad. And I'm still playing that expiration. So when I rinse that out, I'm basically restarting, but using the same expiration. Now let's look at this one. All right, so we're going to go to September, the August 19 position, and what we have here is a double calendar. You can kind of see it poking out there, and on top of a 30 delta condor. I think I have a long in there somewhere too. I have to look at the page trade, the trade page. But anyway, right now the P&L's at $200, so I'm not gonna do any further adjusting. I just want to see if that theta comes in a little bit more. If it starts to get up on one of our break evens here or here, then, for example, like if the market moves up tomorrow, okay, like let's say it starts moving up to here, and I start to break down right about here, P&L starts to go down. Now at that point, I'm looking at my deltas. I have 6 deltas, and the theta delta ratios getting out of control, right? So very easy. You go in, we are in this time frame, right? And you want to eliminate those long deltas. So you're gonna buy a vertical. Okay, let's see how that looks. So doing that, if we get up here, let's review. So if the market ramps up here on this break even, we start to lose. And we don't want to get too far. We don't want this loss to get outside of what we can make in a day. That's the key. See, a lot of times people just they let the market get way out here, and see, if you're out here, it's going to take you days to get this back up. If the market freezes at this price, now you don't know what to do, right? But we know what to do because we're managing by the Greeks. So market gets up here, well, you're not going to let it get that far away from you. You're going to come here, see, at $60 down, that's when you would look at your deltas. You need to eliminate 6 deltas. So we bought this vertical here, and that eliminated that and extended our break even, right? And brought our P&L to a positive place. All right, so this kind of thing has really changed my perspective on option trading in general, because I thought it was, for a long time I was going with losses and I couldn't figure out why. But when I went back and looked at it, it was mainly because of 2 things. Either I wasn't controlling Vega, or I didn't know what to do when delta theta ratio was getting out of hand, or my P&L open versus my theta was getting out of hand, right? And so you're probably wondering, well, what if it goes out here past that point? Well, if the market keeps going up, okay, assuming you're not in a loss, you're not gonna, the first question to ask yourself is, am I in a loss, right? So let's say it takes a couple days to get up there. You're making money. But let's say it goes up on that, that final break even. What am I gonna do? Well, at that point, remember that that's not the expected move. Okay? So the thing you're going to do is just take everything off, or take the little profit you can. Take everything off, rinse and repeat, taking this whole position off, and you're going to restart the position over. And of course, you have to look at the market condition. If things are moving super fast, and the average move in a day is like 3x what it is in a typical day, then you stop and you wait for the market to calm down before you jump back in. But see, the key here was you just get out. You take off the whole position, and with the idea that that's going to happen sometimes. But the win here is not that you made money. The real win is that you didn't lose money. And that's a hard thing to get. You didn't lose money, because remember, markets are going to expire. And this thing is going to do what it's going to do. Every day it's going to get more and more profitable. But whether you're inside that range or not, it's a different question. If you're inside the range, great. If you're not inside the range and you way down here, well, you don't know how to manage your positions. Okay, and that's why people don't make money, because they don't know how to manage by the Greeks and defend those losses when they, or take minimal hits when they reach those break even. Okay? All right, fellas. Take care.